Hey traders, this is Heather. Happy Friday. We've got another exciting week behind us. Never a dull moment, am I right? Okay, so I want to start out with looking at QQQ. I know I typically start out with SPX because she's my girl, but I do want to take a look at the NASDAQ as well, just because I know that a lot of you like to trade it as well. So I do want to make sure that the Qs don't get neglected. So what we're looking at here is a daily chart, and I have the weekly quant pivots set up right here. That's what these lines are. If you don't know, these two red lines are the H1 and the H2. H stands for high. Down here we have the L1 and the L2. L stands for low. Typically what we see is that price remains, or at least, it typically stays within the H1 and the L1, but even more often than that, it closes inside that box right there. This is called the sandbox because it's where price typically likes to play. And if we look at the Qs, that's exactly what happened this week. So while price did go outside the sandbox for 2 days, it ended up closing right back down inside of it. So how do we play this? Well, we actually did this in the small lot trading room, and we actually had 3 opportunities between QQQ and SPX. We had 3 opportunities this week to trade off of the weekly quant pivots. 2 of those trades we won, 1 of them we lost. Can't win them all. So overall, very profitable. Not only did we win more often than we lost, but our profits were bigger than our losses. So that is the right formula to grow an account. So looking at the Qs, what did we do? Well, on the first day, which was Wednesday, on the first day that price came above this H1, we sold a call credit spread. We chose Friday's expiration today because we want to look at when that period ends, okay? So this is a great example of why you need to choose the end of that period and not just the next day, because price can leave that sandbox. It can go above the H1 or below the L1, and it can stay there for another day. Or, if you're looking at a longer time period like the monthlies, it can stay there for a week or, as long as it wants to. But what we see is that by the time that period ends, that's when we typically see price come back in that sandbox. So we sold a 2-wide call credit spread on QQQ. Of course, you can go as wide or as narrow as you would like. And we collected a 145 credit for that 2-wide. So we were only risking 55 to make 145. Pretty good odds, right? Or pretty good risk to reward, I should say. What are the odds? So I'm really glad that you asked because I have them right up here. While price touches that H1 27% of the time, it actually only closes above the H1 19% of the time. That means 80% of the time, 81.6 to be exact, price is going to close somewhere in this sandbox. Doesn't matter where, somewhere in there. And it sure did. So we ended up buying back the call credit spread for 6 cents today. So we locked in $139 with a $55 risk. Not bad, especially for a small account. Now let's go over to SPX. And we're going to look at the same thing, although it looks a little bit differently. So Monday is when SPX actually breached this H1 at 68.98. That was a great sign to me because not only is that where the H1 was, but that's just below a major psychological level of 6,900. So Sure enough, we were able to grab a 5-wide credit spread on SPX. We sold the 6,900 calls and bought the 6,905s against it, sold it for a credit of 315. And then yesterday, we were able to buy it back for 50 cents. So that is what are we talking about? Let me do the quick math. We locked in $265 in profit. Only had a 185 risk. So again, really, really good risk to reward. If we want to look at the stats on SPX, they're even better. So price only touches the H1 25.8% of the time, only closes above it 12.9% of the time. So again, really good odds of the trade working out in our favor. And then you pair that up with a really good risk to reward. That is a recipe for building an account of any size. Now, I'm talking about alerting these trades in the small lot trading room. But if you have a larger account and you can handle a much bigger risk than $55 or $185, by all means, you can do multiple contracts, you can do wider spreads, tailor it to fit your account. But the bottom line is these levels are really, really solid. And so I look at them constantly. They are always on my charts, and I'm always looking for those opportunities to trade when price does move outside of these levels. Now today, we got opportunity number 3 when price dipped below the L1. So we had a huge gap down. We actually gapped down below that L1, kept selling off, did get a bounce, but unfortunately fell back below. So at the close today, or about, I would say it was probably about 30 minutes before the close, we sold a put credit spread targeting a move back above this L1. Unfortunately, as you can see, didn't make it. How much did we lose? 150. We were risking 150 to make 350, didn't get it. So overall, on these 3 trades, we still ended up positive on the week just from these trades alone. Like I said, you can't win them all. So that's what a loser looks like. It does happen. As I say, every single week, no trade or no indicator works every single time. Nothing is 100%. No strategy works 100% of the time. So that is why we manage our risk and look for our edge. But if you win more than you lose, I'd say you are doing okay. So let's look into the future. Now that you know how I traded these quant pivot levels this week. And just as a reminder, I do post these levels in the Mastering the Trade room every Monday, as well as the small lot trading room. So just because you don't have this indicator doesn't mean that you can't get these levels from SPX from me. But let's look ahead into next week. Are we going to keep going lower? So look at what happened on SPX this week. This is my little trend label right here. He has been a helicopter for several weeks now. Helicopter means that the moving averages are choppy. They're not stacked positively or negatively. They're just kind of all over the place. Today, they officially turned into a bearish formation, meaning that they are stacked negatively. So where could we go from here? So I am a subscriber to Spot Gamma. I talk about Spot Gamma a lot. They offer some great data that you really can't find anywhere else. And the information that they provide, I have found to be very helpful and very solid. They have been saying for, I think, a couple of weeks now that below 6,900, we've got negative gamma all the way down to 6,600. So it's definitely possible that we could see 6,600 in the near future. We actually opened up a put butterfly in the small lot trading room We're targeting 66.50 on Monday because I do think that we're going to get some continuation on Monday. Could be wrong, but I do think that we'll get some continuation on Monday. So we are targeting 66.50 in SPX. However, the way that we traded it, because remember, we're working with small accounts in the small lot trading room, instead of using SPX, we are using XSP. XSP is still an index, so you have all of the advantages of trading an index, meaning it cash settles, you get some tax benefits in there as well, but it's only 1/10 the size of SPX. So instead of looking at 66.50 on SPX, we're actually looking at 665. We opened up a 5-wide butterfly. That means that 665 is our center strike. 670 is our first long strike. And 660 is our second long strike. So anywhere in this zone right here on Monday, we should see some profits with, of course, the most amount of profits being at 665 in XSP or 66.50. This butterfly cost us 45 cents, max profit of 450, and we got 2 of them. My plan with this butterfly is if it goes in our favor, I'll take the first one off for a double. That way we've eliminated any risk whatsoever. And then if I can get 50% the width of the spread, which is 250, then I will take off the second one. And then of course I'll adjust from there. But obviously, if you are not in the small lot trading room, you were not able to participate in this trade, but I still wanted to point this out because what I'm finding is a lot of people aren't even aware that they can trade XSP instead of SPX and really, really limit their risk. So this is a really wide net. In order to get a 50-wide butterfly on SPX, instead of 45 cents, it would have cost us $4.50. It's a little bit too much for a small account. However, if you have a large account, by all means, you could do this too. But a 50-wide butterfly on SPX or a 5-wide butterfly on XSP, that's a really wide net. So as long as price continues lower, I think that we see some profits on Monday. Again, I could be wrong, but it's a small, small risk. I am looking for a continuation on Monday, not just because of how we closed out the day, but also another thing that I reference a lot is the Stock Traders Almanac. Tends to be very, very accurate. Again, I'm going to say this because it bears repeating. Nothing is ever 100% accurate, but statistically, according to the Stock Traders Almanac, statistically, Monday, March 10th, right? Yeah, the 10th. No, the 9th. Oh, I'm glad I double checked. Okay. Monday, March 9th is statistically a bearish day. So that gave me one more reason to enter into a bearish trade for Monday. Here's where you can take advantage. Okay, here's where I've got something for you. Tuesday, the 10th, is statistically bullish. So let's assume that it's right on Monday and we do get continuation to the downside on Monday. You could enter into a bullish trade that expires on Tuesday. Now, I can't really give you any good strike levels because it really just depends on how far we go on Monday. But think about what I just showed you in XSP if you do have a smaller account, or maybe you have a mid-size account, but you just want to cast a really wide net. You could use XSP for a call butterfly that expires on Tuesday. You could make it 5-wide or you could even make it 10-wide. Another easy way to do it, if you don't want to do a butterfly, is you could just buy an at-the-money call debit spread on Monday that expires on Tuesday. So can't really give you the strikes right now because I don't know what they'll be. But I did want to pass along that idea to you. Okay, going back to SPX, now what I want to do is switch over to the monthly quant pivots because I still want to discuss how low I think we could go. So let's look at those monthly quant pivots because that will give us, that's a good starting point, okay? So we have the monthly L1 down at 66.40. Now I'm going to switch to the weekly chart just so that we can get some more data up here with our stats, okay? So this is analyzing 47 periods, 47 months. That's a decent sample size. How often does SPX hit the L1? It only touches it 21% of the time. It only actually closes below it 8.5% of the time. So, as I mentioned, I think it's very possible that we could see 6,600 in the next week or two. If we do, I'm going to use that as an opportunity to target a move end of month above the L1 at 66.40. What I would do is I would sell a put credit spread that expires on March 31st. Remember, we always want to do the last day of that period, okay? It might come out of it tomorrow, but it could keep going lower. So I want to use the last day of that period, which in this case is going to be March 31st. I would sell a put credit spread where I bought the 66.35 puts and I sold the 66.40 puts. So that's a 5 wide. I need at least a 1-to-1 risk to reward to round out that trade for me. So since it's a 5 wide, I need to get at least 250 in credit in order to actually execute the trade. Okay? I'm okay with that risk of 250, and I'm really okay with these odds of it closing above that L1 over 90% of the time. All right, so that's another trade idea for you. Let's look at some swing trades. So now that we are bearish on the daily chart, and I've already been focusing on day trades, but now that we're bearish on the daily chart, I want to focus even more on day trades or just overnight trades in SPX. That doesn't mean that we can't find a few honey badgers out there. So let's take a look. Okay, so the first one that I want to look at is CVX, Chevron. All right, look at this. Beautiful ideal squeeze with rising momentum. Okay, it's a little bit high up for me right now. Let me change this chart really quick because there actually are some voodoo lines that I want to look at. So stand by. Bear with me. Sorry about that. Okay, let's try this again. Okay, so beautiful ideal squeeze, rising momentum. Price is just a little bit high for me, but see how it's running into this snow line? It's actually made a couple of attempts, and every time it's gotten rejected. Eventually it will break through, and typically a squeeze firing long will offer enough power that it can break through. So with any luck, we can get a little tiny bit of a pullback on Monday. Maybe it's just to about 188, and then I could look to enter a bullish position. What I would want to do is target that tree line up at 200. Not only can that tree line act as a little bit of a magnet, but 200, great psychological level, right? It also has a 4-hour ideal squeeze, so I really, really like that. I think that I would use the April monthly expiration instead of the March, just to give us a little bit more time. If you do have a larger account, you could probably get the 190 calls. That's just, well, it would be just barely out of the money if price fell back to 188 for about $8. Okay, that's not bad if you have a larger account. That's a little bit too pricey for us, those of us with small accounts. So if you have a small account, I would be looking to buy a 195, 200 call debit spread for about $1.60. Okay, so you've got a couple different options there that you can kind of adjust and play with depending on the size of your account. Next ticker that I want to look at is Costco. Okay, so Costco was in an ideal squeeze. It fell out of it yesterday. Yesterday being Thursday, not only did it have earnings, but also market made a huge gap down yesterday. So it just kind of took a lot of things with it. I love, and I'm so encouraged by the move that it made today, because not only did it gap down with the rest of the market, but look at this. It totally recovered. Didn't just go higher, but it actually went green on the day, and it broke right through that tree line. That is showing me that there's a lot of strength. So it's above the tree line. It is above the daily 21. So no longer in an ideal squeeze, but it actually could get back into it, I think, if we just give it a couple more days. So that doesn't scare me that it's not in an ideal squeeze. What would I want to target? This snow line right up here at 1050. So I would, if I wanted to play that, I would be looking at a call debit spread 1040 by 1050. But look, instead of going out to April, I would actually be using the March monthly, because if we take a look right here, the weekly ATR is 44. So I think if we give it 2 weeks, it could absolutely hit that target of 1050. And this is going to be a good defensive stock to be in while there's so much uncertainty. Okay, people still need the staples. In fact, I was at Costco 3 days ago and they were out of toilet paper. I was like, come on, are you kidding me? Are we really doing this again? Apparently we are, okay? So all those toilet paper sales have to translate into something. I'm hoping that they translate into a move into 1050 in the next couple of weeks. Okay, so that is what I have for you today. But before I go, I want to point this out. Did y'all catch TG's webinar? If you haven't, we're going to put a link down in the comments where you can watch the replay. He's actually teaching a class on this tomorrow, Saturday, March 7th. I actually got to see just a little piece of what he's looking at and what he's working on when we were at the Money Show a couple of weeks ago. Now, TG is not only a friend of mine, but he's a great, great teacher, and he always amazes me at the stocks that he's able to find. And he and I have a very different approach to the market. And I love his outlook, and I always love the tickers that he's able to find, and he's really good at finding those turns in the market and then also in individual tickers. So definitely check out the replay in the link below if you want to sign up for his class. It starts tomorrow, so you don't have a whole lot of time, but definitely check it out. Of course, it's the end of the week, so we've got to talk about reflection, going back through our trades of the week, seeing what we did really well, seeing what we could work on and do a little bit better next week. I'm going to tell you what I'm working on. So yesterday, I saw a setup to trade one of the daily quant pivots at the end of the day. And I even talked about it in the small lot trading room. Okay, I had everything there except for my trigger to go long. I was watching the internals. I turned away for about a minute. Price took off. I got that signal, but I wasn't watching my computer. So I missed it, and it would have worked. So I was really, really bummed about that. Definitely feeling some FOMO about it. So here's what I'm going to be working on this weekend, because one of the things that I talk about all the time is replacing FOMO with JOMO. JOMO is the joy of missing out. So listen, we shouldn't be glued to our computers all day long, every second of the day. Okay, that's actually not a good recipe for a growing account. So the cost of that is that we're going to miss out on some winning trades. So that's what I'm going to be focusing on as I reflect on the trades that I took, and then one that I unfortunately didn't take. I'm going to be focusing on remembering JOMO and not FOMO, because in the long run, not being glued to your computer is actually going to be better for your P&L. So I need to remind myself of that. Think about if there's anything that you can remind yourself of, or anything that you can do better next week. With that, I am going to say goodbye, farewell, have a fabulous weekend, and I will see you in the trading rooms on Monday. Happy trading, y'all.